Hello, I'm Maarten Ackerman, a strategist with Citadel Asset Management here in Cape Town. Since we last spoke, a lot of things have happened in the global economic landscape. Probably the most important is the fact that we do see much more uneven global economic growth and some diverging trends between what's happening in the US and the UK and the rest of the world, Europe, Japan and emerging markets. If we quickly look at the US, then yes, the US is still doing fairly well. The job market is recovering, and over the last 3 months, we've seen some of the strongest job recovery in 17 years. On the back of that, the expectation is still that the US is likely to hike interest rates later this year, and the expectation is obviously supporting the dollar. Now, the stronger dollar right now is slowly becoming a headwind for the US economy, and therefore, the beginning of this year, we've seen a little bit of a slower start to US economic activity as the stronger dollar is weighing on some export activity, coupled with the fact that it's been another cold winter that's putting a bit of a cap on consumer spending. Having said all of that, we still think that the US economy is likely to grow around about 2.5% to 3% over the next few years, which is a great environment for companies to remain profitable and do business in that economy. On the other side of the Atlantic, in Europe, last year's been a very difficult year, and at the beginning of this year they started announcing their own quantitative easing program where they will pump 1.1 trillion euros into the economy until September next year. On the back of that, we did see a rebound in consumer confidence, some better retail numbers coming out, and definitely an appetite for credit again for the first time in many, many years. These kind of trends are likely to support economic growth in Europe, but they are still facing severe challenges. One of those probably the high unemployment in the south, and these kind of challenges will keep a cap on potential economic growth in Europe, and we do think for that reason Europe will struggle to get more than 1% economic growth for this year. At least for now, they avoided a Greek exit. That added to confidence in the region, but the political uncertainty and challenges in Europe will remain on the agenda for the near future. If we quickly turn to Japan, then last year Japan's been in recession, largely on the back of the tax increases that they've announced that put consumers under severe pressure. Now it seems like they're emerging from recession, but still they've got some severe challenges that they need to sort out. Consumer consumption is still below levels we've seen before they've increased taxes. So the government there is still talking about more stimulus to try and revive the economy. And in doing that, also trying to revive inflation. Although inflation is positive at this point in time, closer to the 2% that they're targeting, we don't see that real wages are increasing. And that's really what the economy needs over time to support consumption, inflation, and to make sure that they're winning against deflation will be sustainable over time. Finally, if we talk about China, which is the second biggest economy and also very important for emerging markets, then yes, the slowdown there continues. But what we do see is that the consumer is picking up. They did create a lot of new jobs in the urban sector during 2014, in fact, the highest on record. And this is helping the economy to transition from infrastructure development to a consumer-based economy. The government also announced during their first meeting this year that they will supply more stimulus in terms of fiscal and monetary stimulus, removing more red tape to make sure that the economy can maintain a growth rate somewhere between 6 and 7%. Having said that, China slowing, China having less demand for commodities do weigh on other emerging markets, and the rest of the emerging markets are also struggling. We see that Russia will be in severe recession this year, probably on the back of the sharp decline in the oil price. Brazil is also playing with recession, given a very, very tough environment for consumers. And in South Africa, we're also going to see below capacity growth for a lot of structural issues that we need to sort out locally. So for emerging markets, it's basically up to China and India to actually keep up growth and to mean that emerging markets are still likely to grow slightly faster than developed markets, but mainly as a result of those two countries. Pulling all of this together means to us that the global economic growth can still be anywhere between 2.5% to 3% over the next couple of years, which is still a good environment for us to find great investment opportunities, for companies to remain profitable, and for us to make sure that we can protect and create wealth on your behalf over time. Thank you very much.